I would buy Franco at 140 over First Quantum where it is right now. The gains you tend to see amongst the real specky uranium deals can be off the charts, and they can make up for a lot of dismal performance in other commodities that you might be exposed to. Because ultimately, the rubber's got to hit the road at some point. You can have uranium in your name, but do you actually have uranium in the ground that is going to be of value? Whatever happens in the world right now, even if there are concerns about growth in certain areas, and the reality is the world's going to need a lot more copper. And I don't think that's necessarily going to see a whole bunch of majors acquiring a whole bunch of juniors for their copper projects. To me, if you're a mining company, you have to have a business model that is not, we're going to get bought out.
All right, Doug. I suppose you need no introduction, so I won't lose your time with one, but I will write one in the description for people who want to know more about you or your company. But what I do want to talk about is what's happening with First Quantum here, because it's likely one of the most beaten down multi-billion dollar market cap mining companies with operations across the globe. And it's just a huge, it used to be a decent company in my eyes, and I have no idea what's going on, but it's gone from what, a high of some $40 or so earlier in the year to now under $10. And it's, yeah, is this a steal? Is it a falling knife? What do you make of the whole thing?
I mean, yeah, it's very rarely you see in the mining space a multi billion dollar company that collapses that way. Yeah, obviously Cobre Panama was a huge component of First Quantum. And it was going back to when they acquired Inmet for that asset. Um, yeah, it's hard to say how it will play out. I cannot imagine that that mine will not be a component of Panama's economic future. I can't honestly say I've studied enough of the background to determine whether First Quantum, will be part of that mine's future. First Quantum have a history of very successful international arbitration, and winning in that. They did in the DRC years ago. So is this a case of resource nationalization that won't have recourse in terms of benefit to First Quantum? It's hard to imagine that's just going to be lost
Hmm.
with nothing back. But it's such a key component of First Quantum that probably the fall during this time is warranted. I think the more interesting one is Franco Nevada. I was looking the other day. I mean, Franco's obviously an incredibly powerful royalty company. I mean, the creme de la creme. They've lost $8 billion or $7 billion of market cap during this period as well. I can't imagine that the value of their royalty stream or whatever it is that they have on Cobre Panama can be that much of a hit to Franco Nevada. So in many ways, I don't know if I want to play the catch the falling knife on First Quantum, but Franco seems to have been oversold as a result of kind of this indirect exposure through First Quantum on Cobre Panama. Franco's at a very interesting level, I think, around this kind of 140 Canadian level, I think it was yesterday. And it just feels like that big hit for them as well, unusually large hit for Franco. There's always that saying, you date the miners and marry the royalty companies. I mean, you don't tend to see this kind of volatility in the royalty space, and yet Franco has demonstrated it. That one I feel is the easier purchase of the two. I
Hmm.
would buy Franco at 140 over First Quantum where it is right now. Even though, yeah, at some point I'm sure that there'll be more clarity in this fluid situation. And but I'm not an expert on Panama, on their arbitration treaties and everything else, and what recourse First Quantum have. So it's probably why I'm being uninitiated in all that is why I would avoid kind of playing a bounce on First Quantum, but I feel like there's a bounce that will come on Franco Nevada that I don't have to be an international law specialist on Panamanian rules of law.
You make a good point for Franco Nevada, actually. I haven't been paying attention to it, but it's down was down 27% over the last 6 months. And looking back at the chart, it's basically erased all of the gains that it's made since 2020. It was 120 in March of 2020, and then now it's 140. So almost all the gains from March to now have been erased. It's been basically flat.
Yeah.
And so what I'm thinking about is that obviously everything that's happening with First Quantum is not great for the overall copper supply in the meanwhile. Whether it comes back into production or not is sure important, but also what it matters is when does it come back into production at full speed. And this also comes in on top of Glencore cutting production forecasts. And well, you could say that's not a big deal, but the Glencore thing then comes after Codelco, and Anglo-American had already done it. Anglo-American's also fallen a lot on that news. And the red tape issues are only part of it, of course, but there are parties like Teck Resources that are struggling with still higher costs, although the copper price has not necessarily followed inflation. And there's really too much to talk about when it comes down to how hard the copper supply chain is expected to be hit. Yet the copper price, well, basically couldn't care less. What do you make of that whole thing?
Yeah, I mean, the one there was very much. I mean, the copper bulls will be looking out a few years and saying that the copper supply demand situation is becomes, I think, more of an issue a few years out, and then suddenly Panama happens, and everyone's now talking about a copper market going into a structural deficit in 2024. Um, I don't think the metals prices tend to react immediately to that. I think it's a little bit more of a wait and see approach. I do believe that copper is um, vital, regardless of where you sit on the spectrum in terms of EV revolution and everything else. I it's the only metal that I play in, let's call it the battery electrical transmission type space.
Hmm.
And the example I always use is, for companies wondering about advancements in battery technology, and I know everyone's got this, huge interest and love for trying to find new sources of nickel sulfide mineralization. And nickel, it seems to be, probably one of those key metals. There's lots of other ones in the battery space, which make me think back to the evolution of our viewing technology. Back at one point, it was Betamax, and I'm dating myself now, but Betamax versus VHS. And VHS won. And it was like, well, screw you guys. And then suddenly a tap on the shoulder. Well, who are you? Well, we're the DVDs. And DVDs were the next thing. And then it was Blu-rays, but it wasn't just one Blu-ray format. It was two different Blu-ray formats, and one of those won out. And now eventually, after all these different bits of technology that we've all now recycled at our local electrical store, um, we just stream this stuff. And all those players, all those advancements in that stuff, it's just streaming. And in many ways, I look at copper as that streaming of our media now. It's the final last mile transmission side of things. And all that kind of battle as to which standard for watching a movie on was this kind of fight on to which metals are critical in batteries.
Mhm.
And ultimately, I don't want to play that bet on should I be buying a DVD player or waiting for the next generation. I just want to play final transmission, and that's copper. And that's such a key component on EV vehicles and hybrid vehicles and the like. So whatever happens in the world right now, even if there are concerns about growth in certain areas, and the reality is the world's going to need a lot more copper. And everything that's happening now in the copper space is, I think, going to exacerbate that demand for copper a few years out. And I'm not surprised that the copper market isn't dramatically reacting to things going on the supply side right now, because it doesn't tend to have that, crazy price volatility to almost match these moves. It will be a trend, and I think the trend is going to be upwards over the next few years. And so I'm, obviously my company is involved in gold, but the other thing that we're involved with, partially indirectly, is copper, and those are two metals, very different. One very much for its industrial use, and one for its kind of safe haven status. That's where I've made my bets, and I think copper is going to be here to stay and have a much stronger market a few years out. But I'm not honestly surprised to see a lack of reaction in the copper market to all this, very considerable copper news, which has pushed, forecasts of 2024 being into the structural deficit. And that did not exist. Those conversations were not being had a few months ago.
Sure. And you say that the reality is that we'll obviously need more copper, but I'm thinking who would actually know that is the company selling copper, because they see, orders that they have coming in. And what's making me sort of doubt, or maybe even just not necessarily question that belief, but think about that belief, is thinking about M&A in the copper space. And we haven't seen much of it because, well, partly because, again, of red tape, where Canada, for example, would block deals that the Chinese would get interested in. And the Chinese are investing a whole lot of money in copper within their BRI. And but so should that maybe also be part of one's decision process, what's happening here when it comes down to M&A, as in, sure, we might have, a great deposit on our hands, but we're clearly not building it ourselves as juniors. And if someone wants to buy in, the only one with that much money easily available for M&A would be China. And so it's a twofold question, I suppose, but maybe our government wouldn't allow for the deal to happen. So number one, why isn't there as much M&A? And number two, do you look at M&A when you're looking at potential deals for your own portfolio?
Oh, well, I mean, if we're talking M&A of kind of bigger companies acquiring assets that are in smaller companies that obviously lack the technical expertise and funding for it, I've always felt like it is a real challenge if you are developing. The Lassonde curve exists for a reason. Like, everyone wants to sell their asset right on peak one of it, and when they don't sell at peak one, they then go into years of studies and everything else, and in many ways what those studies do is just highlight this capex chasm, especially in copper. I don't believe it's the case. I think everyone thinks copper capex starts with a B, and we're going to take a different approach and try to do it with far less capital intensity. But the problem for a lot of juniors that have big copper assets, big copper resources, it's like they might be a 10 million or a 30 or $40 million company. They've gone through these studies because the asset clearly wasn't attractive enough to find a suitor at the first peak of the Lassonde curve. Now they're into studies, and all they're really doing is pricing that capex chasm. We're a 30 million market cap company, and the copper, yes, our project could deliver a much needed boost to copper supply, but it's going to come at a capex number that's 20 times our market cap. And so they clearly only have a path through M&A, to be bought out, to actually see advancement of their project by someone else. And the issue for the potential suitors of those types of assets is, if they've got a whole bunch of money, like say they acquire a company that's a 30 million market cap, they buy them for 60 million. Now they're facing $1 billion capex for that project. A lot of these big copper companies could deploy that $1 billion at brownfields expansions of existing mines, not having to start up something new. Um, and a lot of those majors have in their book on their bookshelves, a whole bunch of assets like those.
Mm.
I mean, not saying they've all got 10, projects that all could be built if they had $1 billion for each one of them, but there's a lot of copper already and development assets already sitting in the very majors who are the ones that can kind of almost put the junior copper developer with a big resource but a big capex ticket attached to it out of their misery. And so I think this is why a lot of copper projects go cycle to cycle and get recycled under a new banner, and that they don't actually get developed, and they sit there. Yes, there's a defined amount of gold that's had some economics framed around them, and the next copper cycle it will probably be brought up again. And you see this in other metals as well. So I mean, I always remember back to a Teck presentation they gave years ago when zinc was flying, and Teck obviously have great exposure to zinc through Red Dog, but they were asked if they had $1 billion, what metal they'd invested in, and the answer was copper. And they've got their own investments they're making right now in copper with big copper capex overruns at the QB2 expansion. And that's the other concern right now in these inflationary times we're living in. A particular sticker price on a project in terms of capex now is going to be very different 3, 5, 10 years from now. And God knows what that number is going to be like. But, faced with permitting challenges and water management issues and everything that is impacting the mining industry's ability to drive project development quickly enough to satisfy some of the very deficits that we're facing in metal supply. Um, there's also that big, elephant in the room right now of, something that could cost $1 billion now. By the time you're actually building it from, 5, 10 years from now, is that number $1.7 billion? Is it 2 billion? And I think there's a certain reticence to commit right now. And so I think you just projects which are already slated for going through the expansions, that's going to happen. I think low-hanging fruit at existing operations that have brownfields expansion, makes far more sense than starting something up brand new and building something brand new, which comes with all manner of peril, I think, in the current environment we're in.
Mm. Well, that last part is important, right? In the current environment that we're in, how long is it going to take for us to get out of that current environment and go to the point where the majors are actually buying those smaller assets?
Yeah, I mean, the cost of capital's got to drop. Inflationary pressures impacting these. I mean, I question even whether we have the the manpower, skilled manpower capability. It's not just,
Mm.
if you'd asked me 3 years ago what were the two biggest challenges facing the mining sector, I would say routinely permitting and water management. And I think everyone has been seeing in last couple of years that there is what a lot of people have been talking about prior, but it's really coming to the fore, which is skilled labor shortages as well, which has been a big driver of inflationary pressures in North America and Australia and the like. We don't have a lot of good teams coming through, being educated, coming. I mean, that takes for some of the top mine building teams right now, that's decades of experience, with the mistakes that you learn from and everything else. And, I think this is something lost in everyone's, you know, um, push for net zero and how much copper we need to develop. It's like, who are the people that are actually going to build these things? I mean, small company like us definitely has its bandwidth limitations and that's why we're sequencing our mines and bringing them on in sequence. But I mean, whether you're a Teck or an Anglo or a Glencore, you don't have 10, 18 mining teams to go out there and say, okay, you're going to build that one, you're going to build that one, you're going to build that one. And then you couple the fact that we're seeing decline, a lot of the low-hanging fruit has been developed. We've seen big declines in low capital intensity SXEW copper production over the last 2 decades. We're seeing, a lot of the world's great open pits, have been found, and there will be new discoveries. It's amazing how, you think, well, how could we have missed another great open pit? And then a discovery will be made. And, some of them are 10 years in the making, like Philos, as an example. But I mean, Machu Picchu, everyone sees those iconic pictures of Machu Picchu now. It was only discovered, a little over 100 years ago in the jungles of Peru. Um, so something which now is synonymous with one of those great world, spots like the pyramids or anything else, and yet is a very recent, relatively recent discovery. We'll make other new big copper discoveries where it's like, how did we miss that? Um, you know, Great Bear in a gold camp like Red Lake, made an open pit discovery out there that had people scratching their heads. It's like it was there all the time. It just wasn't where people were looking in the past. So we'll get those, but I think we're also going to be seeing a tendency to go underground and deeper. And you look at projects where people are always thinking, okay, can it be done as a block cave? And who have good block caving experience
Mhm.
here. I mean, the Newcrest team did, and now part of Newmont. But these are skills and standards that are sadly lacking from a broad perspective in our sector to actually get the very project developments online,
Mm.
which are going to drive the supply. And I think that's probably one of the key components of why, you know, the copper price is going to have to go higher to incentivize, development of the very assets that are needed to have some kind of copper balance. And I think that's probably one of the biggest thesis um, for the copper price, moving forward is these things take, can be 20 years from discovery through to actually being built
Mm.
and construction completing. And um, that kind of lead time um, will have been impacted a lot in terms of the last few years and not seeing some of the commitment on these projects that now will have to start in earnest in the next 5 to 10 years to deliver copper 20 years out from now. So I think we're living in a fascinating time and certainly in the copper space. It reminds me of the late 1990s, early 2000s with the whole energy push and the electrification of China. And, copper in late 90s was 50 cents a pound. Everyone was just praying for it to get back to $1 a pound. And very shortly thereafter, it actually had a run up to two. So, I think we can have a very exciting copper market moving forward. And, but I also don't think that that's going to, getting back to your original question, I don't think that's necessarily going to see a whole bunch of majors acquiring a whole bunch of juniors for their copper projects that are just going to sit like books on a bookshelf behind them. I think that they have their own path to taking advantage of this copper market. So if you're a junior, it's like with a copper development project, I think you have to have a plan to like how can it be started smaller? Is it something which is should you be looking at projects that can uh, use lower capital intensity techniques for their development? Because if you're just talking about classic kind of BC porphyries, which are all a kind of zero point 0.3 copper, zero point 0.3 grams gold, they're nice and they can come up with this great in situ content of copper and gold. Um, but they're also pretty routine discovery in BC. It has to have something special to really. You've got to have something special to court the kind of M&A, or caught the value that you will be given by shareholders where you could advance things, yourself. Those ones are very hard to find. Those are the Philos of the world, which obviously, with the Lundin power behind them can look at that as the district, but also was sufficient to warrant BHP coming in as a considerable shareholder of the company too.
Mm.
Those I wish we had more of them because they create such excitement and obviously create a lot of wealth for the retail shareholders lucky enough to be shareholders of them. But they are the anomaly, not the rule.
You make a good point that it takes many years to go from discovery to a mine, and it really does. Like when you say 20 years, I just want to emphasize on that that's not just a saying. Like it actually takes that long. I saw a chart this week. I didn't look up the data myself, so I cannot testify to its quality. But the chart says that it takes the median period that it took to go from discovery from exploration to production was 16 years. And that's looking back. Looking forward with growing red tape and the labor challenges and the water challenges that you mentioned, 20 years is easy. And that's a real time frame. It's not just something people say. So a good point there. But could that maybe be a rule though because when you're talking about CapEx, could it maybe be a rule that if there's like if CapEx starts with a B and this is a very small company, maybe just look at it with a grain of salt, or maybe don't even look at it at all. Like, could that be a rule, or is it too narrow of a rule?
No, I think it's very interesting. I saw this RBC chart that they've done on the reduction in SXEW, effectively leachable copper discoveries. And I mean, one of the reasons they're leachable is that they've declined is because they're found easily. I mean, these are oxide deposits at surface. They're amenable to acid leaching of the copper, and it's far less capital intensive. But the very nature of them being near surface or at surface type deposits means they are the lowest hanging fruit. They're easy to find, should have been found by now. So it's natural that there is a decline in SXEW production. I mean, for me, if I was a junior that had one of those bigger capex type projects that, if it doesn't have some secret special source to it that is going to attract a buyer, it's like, it's going to kind of sit and you're going to spend more money doing additional studies that all they're going to do is show that the cost to build it is going up. I'd be personally, without giving away too much of our business, I'd be looking for smaller scale assets that at least allow you to build something to be meaningful. You have to have like for me, if you're a mining company, you have to have a business model that is not, we're going to get bought out. That you have to have a business plan, which is, maybe if we do X, Y, and Z, someone comes along and gives us an offer we can't refuse. Great. But that can't be the plan A. So if I'm in the copper space, I'd be looking at something which, well, can that be built? It's small. It's not going to necessarily covet the attention of people because it won't have huge NPV behind it. But maybe from a junior developer perspective, we should be focusing on IRRs and generating some cash that can then support bringing on funding to support maybe a two-step approach to how you develop your much bigger resource. So maybe there's a sequence of these ones before you can get to what was ultimately in the company initially. Maybe you need to augment the pipeline by looking at something smaller first. The market seems to be captivated by scale, but that very scale it can be off-putting, because you're going to have a class of investor going, well, no one's going to buy it out. So what are you going to do with it? You've got a $900 million capex chasm. So, maybe we need to be looking and thinking and attracting talent into our companies to advance lower capex alternatives. Because I said this to a group of people because I put it on a slide in our deck. I said, copper capex doesn't have to start with a B. And one of them said to me, you could give Saatchi and Saatchi in London, big advertising company, very well known, obviously. You could give them $100,000 to come up with a marketing campaign, and they won't do a better job than that simple statement. And it just, and it came, I put it down on paper because I've always kind of lamented that we spend a huge amount of capital in this space in small companies that are defining something that clearly they can't develop. And those projects sit around for an age. And in a capital intensive industry that we have, we need to spend capital more wisely than that. And so, is there a plan? You know, junior gold producers are quite common, relatively. There are very few small copper producers. There's a captive audience there if you can do it. And more importantly, if you can develop the first iteration of that copper production, then who's to say you can't be that team that goes after that next thing that's a little bigger and that next thing? And then those projects that are sitting in companies that the majors don't really need, maybe they become very attractive to you as development assets that you can kind of put into the pipeline. But I think it starts, you have to have the plan A, and that has to be a thought process to, you know, if the odds of us getting bought out on this asset are less than 1 in 10, then we sure as hell have to have a business model that have better odds of doing something while we potentially wait for that 1 in 10 shot of a buyout. I think our shareholders deserve that as much as anything else, as well as common sense, I think supports it. So, that, and those are my thoughts on copper, at least, for
That's
what they're worth.
that's actually within my rotation of questions when I'm interviewing companies, is asking them what's sort of the plan here? And they would obviously tell you, well, we want to get bought out. And then you tell them, you ask them, okay, so how much money do you have to spend before getting up to an MRE or something like that? And they say, well, hey, we might get sold before an MRE. And I say, that doesn't happen a lot. They obviously bring up Great Bear and so on and so forth. But the point is, I ask them, what if you don't get bought? What if you go into that thought of the second dip, basically, the first dip after the first peak of the Lassonde curve? What happens there? Are you going to have the money to develop it yourself? And there's one company that was able to answer that question, and they said, well, we have 2 starter pits that we can start up relatively cheaply. This is going to pay back for our capex, and it's going to start cash flowing and on and on and on. So that's the type of answers that I do like. But you bring up a
Well,
good.
and the key to that, Antonio, is it's good. If they're thinking like that, that's good. Then the next follow-up question is, and you know, is do you have the team to actually then develop those,
Yeah.
right? Like there's a very different skill set between an exploration outfit and a mine development outfit. And so you just want to make sure that if you're looking and smartly realizing that you need to have an alternative plan to a buyout, that you also have the other components required as well. You've got to have a deposit that can support that kind of strategy, but then you've also got to have the team that augments around it. But it's good when when a company has uh yeah the number of times I've seen since Great Bear, and Great Bear was an anomaly back in the 90s, pre 43-101, there were examples of plenty of examples of companies being bought out pre-resource. um the reason Great Bear, the quality of data we had at Great Bear absolutely supported it, but I know it still raised eyebrows, because it was something that did happen with a certain regularity 20 plus years ago, but in kind of this modern world that we're in, yeah, definitely again, it's kind of what I said about Philo. Philo's the anomaly, it's not the norm. Great Bear is the anomaly. You should never have a business plan that's based around the outlier, because it just doesn't work like that.
Hmm. That's a very important point for everybody listening who's ever listened to a presentation where, they tout something closely related to Great Bear and that type of thing. It's an anomaly. It doesn't happen every day, and that's why everybody knows about it because it was an anomaly. But so when I ask you brought up a good point before that is saying, do you have the people to build it? And there's basically three things that you would need, and that'd be, can you permit it? Can you finance it? Can you find the people to build it? That's sort of your start. If you have that, that's a first step. And that also coincides with the answers that I'm getting from company CEOs. I'd ask them, what is the biggest challenge right now that you think the industry is facing? That's the three things I hear the most. It's labor, red tape, and financing. And that last part should obviously not be ignored, financing, because it what we're talking about here is it brings the question, how are these companies going to finance themselves in a world of, expensive money, meaning high interest rates and potentially even a broken exchange, maybe. At least that's what I've heard over the conference that you and I met at, about a month ago. But so what do you make of this? Is financing risk for juniors just really growing? Is it extraordinary right now, or is this like a typical time in the market?
No, this is remarkably, when you consider with $2,000 gold, this is a horrendous equity market. Horrendous. Um, Now, you are seeing financings done that maybe send a message that, oh, the market's opening up again. Uh, I think, Argonaut, good example the other day, $85 million. But I would hesitate, I would guess that the bulk of that was done with existing institutions that are basically averaging down with that raise. I Friedland did the 500 million PP on Ivanhoe announced yesterday. I mean, again, these are very specific cases. Um, and in fact, in some cases, I know of one, financing done earlier, this summer that I am 75 or 80 or $90 million. It had a 40 or $50 million lead order on it. And it was still a struggle thereafter. I mean, these are incredibly challenging times. I've talked to bankers that have had decades of experience and they haven't seen markets like this. And I think everyone's kind of scratching their head given where commodity prices are. But um, so it's not just that capital's coming at a real cost right now. There's such a hesitancy because of so many unknowns moving forward. This should be a great time to be in the metal space as an investor. Uh, but I mean, if you're a development company right now that signals to the market that you're going to build something, um, you're probably going to spook a whole bunch of your shareholders who are going to look at examples like Iron Gold at Cote Lake and Argonaut at Magino and Marathon Gold at Valentine, Lake, and go, well, that decision, it was right or wrong. Like ultimately, the equity suffered horrendously in all of those examples. And so, do you really want to take that path as an equity holder? And so if you're the funder of that work, again, you're about to join the ranks of that equity. Again, with all that development risk ahead of you. So it's a very challenging time. We're unfortunately the margin contraction that we have seen over the last 3 years amongst the big boys means that we're not seeing money inflow. Like they're not posting, fantastic numbers. I mean, a lot of these majors, have done effectively pretty much round tripped over the last 4 years. They're and so if you're bellwether blue chip producers are not attracting inflows or not doing things, and showing real growth, production growth, and real margin expansion that is going to drive capital into this space, then you need to see that first. There's always a trickle down effect. The money doesn't come into the juniors first and head up to the big boys.
Mm.
So the performance of our sector has been, Minera's no different, has been a horrible advertisement to say, hey, come invest in the mining space. Unfortunately, and I think that there's tremendous money that can be made in the mining space, absolutely, um, but we don't have a performance track record over the last few years to give a great sign of encouragement. So I think we're in a situation right now where it's kind of like the last scene in The Good, the Bad, and the Ugly, where everyone's looking at each other to make the first move.
Mm.
I think there's a lot of money on the sidelines that can come back into this space pretty quickly, but no one wants to be the first money in. And so instead, we just have more of the same. We almost have outflows controlling the direction of the market, and that just further reinforces the view of that money that's waiting on the sidelines that they can continue to wait.
Mm.
And so it becomes this kind of self-fulfilling prophecy. And I mean, I think you could pick up,
Mm.
randomly, probably 7 charts out of 10 that you could pick up randomly and look like that death by 1,000 cuts over the last 3 years. So there are definitely outliers to it, but unfortunately, again, they're outliers, and that's not a reason to aggressively say this is the time to get in. I think a lot of money would say, look, I'll let someone else make the first 20%. I want to see a rebound in this space that has some legs to it. And right now, we're obviously talking at the worst time of the year, Antonio, because it's tax loss selling season and everything else. So I think what will be interesting is in the new year, in the first quarter, do we see some capital deployed? Like, have funds who've cleaned up some positions or whatever want to place some new bets? And how healthy is that? Do we see a healthy bought deal market in the first quarter? We didn't this year. We saw a couple announced. Uh, because I think the institutions are suffering the same way in terms of their redemptions and overall performance as that we see as retail shareholders,
Mm.
where and so I think the first quarter next year will be very interesting to see if there's an uptick in year on year on bought deal activity and capital raises. It was pretty bad at the beginning of this year. There were a few examples, but not many. Maybe those are the first green shoots that things are going to get better in 2024.
Mm. Doug, I thought this was supposed to be the most wonderful time of the year, but I've been listening to too many Christmas songs. Maybe that's that. You bring up a good point, though. You're right. Some companies are still able to decently finance themselves, and that might be just a generally an interesting point of discussion as well, because you gave a good example. Then the news recently broke Robert Friedland's Ivanhoe Mines is doing a $500 million Canadian, that is, private placement on the back of an increased exploration budget for 2024. So they're just generally more active, and so they don't seem to be in trouble. But it's, of course, it's Robert Friedland, right? I mean, you don't expect him necessarily to have financing issues, but you look at you gave Argonaut as an example. They raised $85 million, not as well appreciated, and arguably not as good of a placement either. So the question here would be, how do I judge the company's ability to keep financing itself? Both sides, the obvious, your Robert Friedlands or whatever it might be, and so yeah, I mean. That's basically a question. How do I judge the company's ability to finance itself?
Yeah, I mean, this market um, it has humbled even some of the titans of the mining sector in terms of their stock performance. I mean, no one's really escaped the downdraft. Um, I had a friend just came back from, I think, one of the conferences that was in Zurich a few months ago, and said his one bit of advice is, if look at the company's balance sheet, and if it needs money, sell. There's just there really isn't much of a market. If you're a Canadian explorer, you can get some flow through money and everything else, but hard dollars, hard to come by. Um, I remember I did this like PSA tweet in the summer of 2020. That 4 good months of mining market we've had in the last 5 years.
Mm.
And because I saw a lot of companies off the back of that move raise a bunch of cash. And I remember saying at the time, if your company has managed to raise $10 million, treat that 10 million like you start treating your money like you get down to $1 million, you're on fumes. And suddenly companies rein back a whole bunch of expenditure and everything else, and oh my God, we're on fumes. And my advice in that tweet was if your company has just raised $10 million, treat it like it's your last $1 million.
Mm.
Because that capital to replace, if you're too aggressive with it or anything else, is going to come at a very high price. And if you treat the 10 million like you do when you have a million left in the treasury, it's amazing how much further that money will go. But this sector unfortunately is so cyclical that those financing windows where you can actually get that kind of capital, it's like don't come along that often. So my God, treat it as the most precious resource, because it is. It's the lifeblood of this sector, and without it, the sector withers on the vine. And we're in that withering stage right now. I mean, you're seeing companies, doing the classic kind of keep the lights on financings where, I think as a shareholder, you have to scratch your head and say, well, what am I actually funding here? Am I funding any work that's materially going to change this company, or am I keeping it alive in the hope that we have another of those kind of 4-month runs like May 2020 to September 2020? That's not a good investment strategy.
Mm.
Hopefully we see some M&A that gets announced. And when I say M&A, I think more the merger of equal type deals, or there are some companies that built up some cash and you hope that some of that can filter down into some interesting targets that maybe, covet some interest from the market. I mean, Hercules Silver is a good example recently of attracting $20 million from Barrick of all companies on a discovery in Idaho. And I think the thing that, I mean, that's great. And maybe we're going to see the royalty companies that have been active in certain development plays be a source of funding. I mean, back in 2015, it felt like a Cisco were being named in just about every funding group. They were great supporters of the sector and funneled a lot of cash into smaller companies. We've seen it with Wheaton. Barrick was eye-opening because Barrick just don't do that. I can't remember the last time Barrick did a PP into something, especially off just one hole. So I think that's why Hercules is trading as well as it has, because of all companies, Barrick to commit, $20 million. But maybe that for companies that have done good work and have generated something of excitement, these majors who kind of want to maybe have some of their exploration costs off their own team and backing good teams that have done enough to justify some support. Maybe we see the sector, the bigger companies actually funnel exploration dollars into some of these smaller companies. But again, it's not going to be a rising tide lifts all boats. It's going to be very, very specific, like B2 into Snowline. It's these very specific cases. A rising tide lifts all boats market does come along from time to time, but it's not actually healthy for the sector. I think we would do much better to focus and to channel the funds into a far smaller group of companies. And from a shareholder perspective, when we're thinking about where we're putting our bets in this giant casino, again, being much more selective about where we choose to invest, I think serves the sector better. Rising tide lifts all boats which we saw in early 2016 and we saw in middle of 2020, I think actually create an unhealthy market.
Hmm. I agree, and it's also not a strategy that I want to base my entire career, if you can call it that, on because it's just it's not as predictable, and it also has additional layers of risks. So, for example, there was a comment on Twitter today. I saw someone tweeting saying, a 50% drop is not a problem. It just doesn't feel good. And I said that I disagree because in this market, a 50% drop is a problem because to break even, you're going to need a 100% gain. And in this market, a 100% gain, you only get on something that is remarkable, as you said, Snowline or Hercules or whatever it might be. And if you do want to wait for that rising tide lifts all boats type of market, you might be waiting for an extended period of time, which results in tremendous amounts of dilution, and maybe your company not even making it to that market, depending on how far up in the future it is. So it's just not dependable, and you have to depend on the company itself. But anyways, I was just thinking about something else that you also said, which was excitement that starts sort of the sentiment going, and you look around where do we see excitement? Where do we have a rising tide right now? And one of those places would be uranium. And I wanted to obviously talk to you about uranium because I've been following it for a long time now, and I have a lot of my money into it. Not because you're an expert on uranium, but because you've known mining for many decades and you've seen many of those booms and busts in many different commodities. So I guess a broad question, but what do you make of it? Do you trust the current run up in uranium? What do you make of the whole thing?
Honestly, every time uranium has one of these markets, I say the same to myself after it's come off, because inevitably it does. And think I should just have this portfolio of junior uranium deals, like the real lowest of the low, because there's something about a uranium cycle that just, yeah, rising tide, and it's like you just have it as this thing you forget about. And then every cycle passes, and I don't do that. And then the next one happens, and you see these fantastic gains in these companies. And I hope people are just smart enough to take profits. I mean, let's face it, unless you're in the blue chip names in the uranium space, the next gens of the world and some of the bigger ones, there's a lot of other companies you have to just look at them and think it's a trade. And that's good. If you can make money in this sector, it's capital that can flow around elsewhere. We seem to be such destroyers of capital that I've never ever I've traded in and out of next gen a little bit. I got some uranium exposure from a directorship I have in a company that's um, focused on Sweden, and there's a big thing on the Swedish moratorium on mining being lifted in Sweden potentially next year. Um, that's one step. Like what we're seeing at the EU level and some of these statements and pacts being made on expanding nuclear that's great, and I think nuclear offers the only true clean base load energy that the world's economy and industry is going to need moving forward. Um, but typically, what politicians say and want, and what people in the communities, I think uranium is such a social license commodity. It's the social license commodity, that people are not going to necessarily feel comfortable until somewhere else in the world has had a period of time without any issues with new nuclear, reactors and new modular reactor technology that has made tremendous advancements. So, since the last, cataclysmic failure of nuclear reactors, which I guess was Fukushima. So, but unfortunately, one of other incidents that have obviously always plagued the uranium space. So I've never really taken a portfolio approach to uranium. So, uh, but the there will be, out of any kind of move in it, there will be new discoveries, and there will be companies that emerge from the pack and become a more of a preeminent player in that uranium space. And then there will be all the other companies that have uranium in their name that won't really amount to much. And those are the ones that, hopefully you take profits on in these kinds of cycles. Because ultimately the rubber's got to hit the road at some point. You can have uranium in your name, but do you actually have uranium in the ground that is going to be of value? You know, very easy to rename a company. We saw it with lithium earlier this year. I think in 1 week there were 5 companies that added lithium to their company name. It's actually one of the cheapest fees you can pay the TSX Venture. It's something like $500 or $1,000 to do a name change.
Mm.
So given all the other fee structure of the TSX Venture, it's one of the cheapest ones. So just because you got uranium in the name, it should be the same question you need to ask about your uranium stocks. And if you know the answer is, do they have something that's really going to be something or not? If the answer is no, then you know that that's the trade. Make money in it by all means, but know what you own. And it should, and in that regard, it's not actually that dissimilar to any other commodity in this space. Like, does it have a realistic shot? Does the project have a realistic shot? Because just because you've got lithium in your name or uranium in your name, that's not what's actually going to drive the kind of value creation where you shouldn't be taking profits on a commodity price spike. Now, I think the future for uranium should be really good. But again, I have very little exposure to the space, so I'll leave it to experts like you that have done well and better than me in this current uranium boom.
Unfortunately, I haven't done better probably than most people because I FOMO'd my way into it in 2021. So I'm actually still down on my exposure. But why I'm bringing this up, Doug, is because uranium companies seem to be behaving differently relative to the price because of that spiky nature potentially of the underlying commodity. What I mean by that is that like it's typical for a uranium company to come out with a PEA that's done at above like 50% above spot price, and nobody's going to bat an eye at that. And it's normal. It's normal for companies to trade at 1.5 times MPV at the current spot price or even above that, 50% above, because everybody expects there to be that spiky price environment. And so why I'm bringing that up is because we were previously talking about, waiting for a rising tide lifts all boat type of thing is maybe not the best idea. It's not good for the market, maybe not even good for your portfolio. But is it maybe different with uranium? Because what's happening right now is that we have that rising tide. It is here. It is fundamentally supported by more, let's just put it that way, more supply, more demand, less supply, right? So it is fundamentally supported. So do you treat it differently and go in whatever type of names they eat that are going to rise with the tide? That's basically why I brought it up.
Yeah, I mean, you make a very good point. The uranium space is the one where you can use a considerably higher uranium price and no one bats an eyelid.
Mm.
You couldn't do that in there. You get derision if you were a gold company using
Yeah.
$2,300 gold.
Mm.
And in that regard, uranium is probably, yeah, very different than just about any other commodity. And does that send a message about the future of uranium? I sure hope so. I mean, I sure hope that we can get over our misgivings of the past with uranium. I think the world can be a better place with a base load fueled by uranium. In terms of, I still believe that you have to know what you own. So you know, the uranium space, I think even more so than, when silver has its run to $30, anything with silver in it, they all had that move. There's something special about uranium companies and uranium shareholders that, the gains you tend to see amongst the real specky uranium deals can be off the charts. And they can make up for a lot of dismal performance in other commodities that you might be exposed to.
Mm.
But I still think you have to understand what it is you own.
Mm.
Take advantage of that by all means, but but don't. marry into it thinking, well, this uranium market's real. This company, it's, yeah, the uranium, maybe this price move and everything is the uranium market's real, but is the company that you own real?
It's a
You
good
know,
point.
and unfortunately, so say, Canada does a lot of things well in this space, but it also has this terrible habit of being like a squirrel jumping at the next shiny object it sees. And we've seen it. We saw when mining's suffering, but doesn't matter because cannabis has come along,
Sure.
and you see all these companies rebrand as cannabis companies, and cannabis sucks. So, they're going to be blockchain, and then they'll bounce between different, and that's why these companies never die because there's always the next shiny object. An important thing from a shareholder perspective is really understanding the team and the corporate history of a company. Is it one of those companies that tends to bounce around or play the area play card, where it doesn't actually do any work of consequence, but it happens to be in the neighborhood of a company doing real work
Yeah.
that's getting real results? Well, I'd rather back and support a company doing real work than playing the lottery ticket of an area play where it's like, what's their motivation here? Like, if I want to play the casino, I'll go to Vegas.
Mm.
I think it's way too easy for us looking at this space to just think they are lottery tickets, but we shouldn't necessarily be thinking that way. We should be trying to beat the odds in the house. We should be, if you go to Vegas, a professional card counter has the best odds in Vegas are blackjack. And you'll still lose money unless you're a professional card counter over time. If you're a professional card counter, maybe you've got a 2% edge against the house. And it's just a volume game over there, and you can get a. I am not, by the way, a professional card counter, but I know some of this stuff because I used to live next to one. And so if you want to play like this space, play this space like your professional card counter. Get the odds at least a little bit more in your favor. You're not going to beat the house necessarily, but you're going to be definitely a lot better than the guy that sits down at the roulette table or whatever and is going on that trip because it's play money and everything else. Money shouldn't be play. Money is important. If
Yeah.
you're going to just blow money on a stock, I'd rather you blow money but giving it to a well-deserving charity. And you should be looking to make money. And so where's your edge come from that?
Mm.
It's understanding balance sheets. It's reading listing prospectuses. CDAR should be your best friend. It's not anymore because they've improved it to CDAR Plus, and we now all regret wishing that CDAR site had ever changed. But uh, there's a lot of things you can do to give you better odds than the person that isn't doing those exact same things. It
It's
doesn't
true.
mean you're going to win against a house like a car counter, but you should lose less in the process of and effectively protect your bankroll sufficiently long enough that hopefully that big win comes to make it all worthwhile.
Sure.
And so uranium companies, lithium companies, gold companies. I mean, the first thing you should be doing with all of them is really understanding not just what they are today, knowing what you own now, but what's that company's history? I know it seems boring, that's all in the past, but actually the past is a really good predictor of how that company that you're backing now is going to serve you moving forward.
Hmm.
So lots of ways to help yourself.
That's true. Yeah. And on the point of setter, I think they really only changed it because we were complaining too much for it being bad, and they just wanted to show us that it can be worse, so that we're not going to complain, because if they change it again, maybe it gets even worse. So nobody's even complaining about it anymore. But it's a topic
No,
potentially.
honestly, I spent a bit of time on it. It's good, and there are a lot of good new features of the new one. But there
Yeah, yeah,
was a simple, yeah, there was a simplicity, almost pre-internet website that CEDAR was in
yeah.
its original form, and with that came this rudimentary simplicity that we loathed, but I think we all secretly loved looking back on it now
Mm.
because
True, yeah.
it was just, yeah,
It's nostalgic and I only jokingly say about it, but I actually Setter Plus that is now C8, so it's setterplus.ca. It actually works relatively well. I agree with you.
yeah, it does.
We were talking about how companies finance themselves. And so there's also something else in the uranium market that happens a whole lot more. Give an example. Right now it's happening with NextGen, as you said, and another one of the companies in the western side of the Athabasca Basin, that's Fission. They do these ATM facilities, right? At to market facilities, which allows them to sell shares into the open market, basically turning the secondary market into sort of a primary market without necessarily having to say anything about it beforehand. And Nixon is doing that, what, $500 million too, I believe, or something along those lines. What do you think about companies who finance themselves that way and pull it off too?
There are some, um, there are a few examples. One does it very surreptitiously that I almost don't want to. They don't. There's one company I know that when there's new inbound interest from institutions, they activate the ATM to effectively, uh, supply that paper that was required to position a new institution. I
Mm,
mean, I personally, I hate them. One of the reasons I hate them the most is I think there should be better disclosure from companies uh, with regard to how ATMs work in terms of overall increases of the share capital of a company. There are companies that will laud the number of shares they bought back in a quarter, but in very small print will be a greater number of shares that they printed through an ATM. So they've actually issued so that they'll make a big thing that they've got a NTIB and they're buying back stock, but they also have an active ATM at the same time, so they're printing the same paper. And I just feel like there needs to be heightened awareness and exposure by companies if they are both using an ATM for print paper whilst promoting the fact that they're buying back stock, which normally shareholders like because, oh, we're buying back stock, but they're surreptitiously pushing that paper out through an ATM. I think that I have big issues with that. I think sometimes companies have put ATMs in place that suggest that they're in a tougher financial position than they really are.
mm,
So I think it can send mixed signals in that regard. Um, you know, I see why for big companies it's a good thing to have, just like companies that file a $50 million shelf prospectus. Um, it doesn't mean that it has a 25-month life to it or something. It gives them an ability, should the right circumstance arrive, to actually have a far more effective process of doing an equity raise in terms
mm,
of restrictions on stock, how you can walk across people, and everything else. And typically, the bankers will say if a company files a base shelf prospectus saying they could be raising up to $50 million or $100 million based on that prospectus over the next 25 months. The bankers will tell you it typically is taken with a grain of salt by the market. But I imagine there are some shareholders that would see something like that and think, oh my God, not educated the same way the bankers are, and think, oh, does this mean there's a huge funding coming? No, actually, it's going to make for a far more efficient and probably reduced cost of capital having that there. But but maybe it spooks some people. I think it all depends on the company. So I don't have a hard and fast position on it, but I do have a particular bone to pick with companies that are printing paper through an ATM
mm. Of
whilst buying back stock, but
course.
only really promoting the buyback of the stock. And I think that if you're going to say we bought back 1 million shares of our stock in the last, that that number should be netted out. There should be some statement in there, although the net amount of buybacks because of our functioning ATM was only 200,000 shares, something like that, just so that in a world where I think we should have heightened disclosure standards, I think it allows a misuse of buybacks and ATMs to kind of bracket basically both bookends of on your shelf, and the net amount might be actually zero, but one is promoted as a good thing, buybacks, and one is in very small print hidden in the financial statements,
Hmm.
ATMs.
Buyback's a topic in and of itself, also topical of what's happening right now. And there is the argument that you have money to drill, but if you drill and you come out with grades, again, that's what we discussed previously, unless they're extraordinary, nobody's going to care. And so you're not going to get value for that in the market. You're not going to increase your company's value for that drilling. So having the money on hand, why don't you just buy back your shares and sit tight until a better market, raise that money again? What do you make of that whole dynamic?
I I personally think that there have to be better things that companies can do than buy back its stock. Like I really, we're talking, you know, I mean, my God, if you're a company and you're worried about, well, exploration is a capital intensive business. So you need the very capital, and you need to have some stones and actually risk some of that capital, to drill things. You know, so I don't think you should like in this kind of market, maybe you slow down how you spend your capital because you know that the money that you're spending has a certain cost to replace right now. But you still
Mhm.
have to function as a company. And the last thing you should be doing is buying back stock. And that's not to say there are companies out there, even smaller companies, that are buying back their stock. And I don't actually have an issue with ones that are generating their own cash and right now have no efficient use to necessarily spend it. They're doing a lot of exploration, they're doing this, they're doing that, and they've still got some excess money and they're doing a small buyback. No issue with that whatsoever.
Hmm.
But yeah, there are times where I look and I think, is that the best we can do? Like in an industry that is naturally depletes itself with every production year and everything else, we need to be replacing that stuff. And it just feels like, can you efficiently spend that cash? Maybe not. For some of the big companies, I think they've actually sent the right signal to generalist investors. They haven't come back into the space yet, but in time, hopefully they will, that there is a certain capital discipline here. And those generalists do want to see, capital return to shareholders. So we're seeing dividend policies and buyback policies and
Hmm.
hybrids of the two. Um, and that's hopefully sending the message that the industry has has taken a very prudent approach to protection of the balance sheet and how it spends capital, because certainly there were periods where we gorged in M&A fests and companies did crazy deals and destroyed a lot of shareholder value that way, and instead they're kind of going the other way and not doing those crazy deals and instead saying, first and foremost, we're going to show that we are um, prudent managers now of our capital. And so sometimes having a buyback policy, or a dividend policy is, I think, about sending the right message. But ultimately, these companies all need to replace resources
Hmm.
and need to show that they are growth stories, because how can you compete with other sectors that are seemingly growth stories if we aren't, and that needs investment, and that investment doesn't come through buying back the stock or paying a dividend. So there's an element where I see the value in it, but ultimately we need to be investing in our future.
Hmm. This has been a very wide-ranging discussion. I really appreciate sitting down with you finally. We've known each other for a while, so thank you so much for doing this. Is there anything else that you came here hoping to talk about, but I'm failing to bring up?
No, honestly, it's refreshing just to bounce, especially actually in topics where I don't talk about too often and realize I actually have a position on them when asked. So,
Appreciate it. Yeah.
apologies for my very basic grasp of the uranium space. But no, Antonio, thanks for having me on. It was a real pleasure and a fun conversation today.